Hey everybody, good evening, good afternoon, good morning, wherever you are. It's time for the Thursday Financial Thing live stream. Hope you're doing well. Hi from the official mascot of the stream, Holly, who is really looking forward to the information that I have to share this evening. It's going to be a short stream, mainly because this week has been kind of quiet in the peer-to-peer lending news information, and I did want to go through the Able Rate report that came through, but unfortunately, unbeknownst to me, because I'm in the US, I don't have access to the Able Rate website and didn't realize that in order to get that report, I would need a VPN, a virtual, proxy network to access it. So next week I will go through that and see if we can unravel some of the mysteries that apparently are in that report. That report apparently, according to Peter Vince, who watches the stream, is quite confusing. So I'm going to see if I can decode it and see what really is going on inside that report. But in any case, I do have a little bit of peer-to-peer lending news tonight. I'm going to look at the Trading 212 portfolio also, and talk a little bit about maybe what the future hold for the stock market for the rest of the year, which I think is going to be quite good, possibly until Q3, because of some of the news that has come out. Also had a really interesting email regarding trackers this week, which from a apparent watcher of the stream, Darren, who we're going to go through that and take a look at an important prison sentence that happened today in the news towards our cryptocurrencies. Anyway, let's get right into it. I want to keep this stream really short and sweet. Hi to everybody who is watching. Thank you for joining. Subscribe to the channel if you're not already subscribed. Please hit that thumbs up. And if you didn't see it, by the way, last week we had Narinder from Cufflink, who's the CEO. I thought it was a really good session. I think he addressed some of the issues that people were concerned about, transparency. Of course, I always want to say we never really know what's going on behind closed doors 100%. We can only go off what we hear and what people tell us. It's very hard, but you just take that information and process it how you will. But if you haven't had a chance to watch that Q&A session I did with Narinder last week, please check it out. It's archived on the YouTube channel. By the way, Cufflink is the sponsor of the Financial Thing YouTube live stream. Very nice of them to sponsor and support. You can earn, actually right now, way more than 9.83%. They have a special promotion going on at the moment. They have over now 300 million of property-backed UK investments made since 2016, zero investor losses to date. Capital is at risk. Please don't invest unless you're prepared to lose money. Remember that the rate that you can get, or that is estimated, returns, those can change because interest rates do change. Nothing is a constant in peer-to-peer generally. Some peer-to-peer companies are, but generally not. Sign up at the link below or go to join.cufflink.com/financial-thing. So let me take a quick drink. It's a very warm and balmy day here too in Orlando today. It was, I want to say this morning it was rainy and gray and not too warm, and now it is a million degrees. I don't know what is going on. The weather is very bipolar here at the moment. Anyway, hi to Peter, of course, in a moist Leatherhead. Colin Perry in the Peak District. Mike Powell is here. George Batchelor in Bridlington. And a very sunny Olaf from Annabelle in Spain. Thanks for tuning in as you do every week. I know you could be spending your time somewhere else and you choose to do it here. And I appreciate that. So, let's take a look. We're going to talk a little bit about ISAs because, as you know, April 5th is fast approaching, which is a deadline for you to put in your ISA amount. it is the only free thing that the government gives you. They give you a £20,000 tax break, I would say, on the money that you put into ISAs. It can grow tax-free, so always take advantage of that. Whether you do it through a cash ISA, stocks and shares ISA, or some other IFISI SA through P2P Lending ISAs. Of course, the rules are changing this year, so you're going to be able to open up multiple ISAs, which is a huge advantage. Actually, did I say this year? I think it's starting next year, for next tax year. That's going to become big because you're going to be able to, even if you were to put in the 20,000, say, into one P2P lending company right now, that beginning on, I think it's April 6th, probably got the wrong date, but whenever those rules change, you can then take that 20,000, split it up into different IFISAs throughout different, you could do part of it in a stocks and shares ISA, part of it in multiple different peer-to-peer lending company ISAs. So it's going to give you a lot more flexibility. It's going to take those shackles off what was once, I thought, a very stupid rule about where you could only open up one IFISA a year. That just didn't make any sense. I don't know why that was put into place, but now that is going to change. Interesting article that the Alternative Credit Investor had. I was really surprised to see this. I mean, this just doesn't make any sense to me, but it said IFISA returns outperform cash and stocks. Cash ISAs returned have outperformed the returns from stocks and shares ISAs over the past year, but the independent finance ISA continues to come out top. So that part I get. The IFISA comes out on top, absolutely. What was confusing to me about this article is how on earth a cash ISA outperformed the stocks and shares ISA. Now, this is a tricky article because we don't really know what people invested in those stocks and shares ISAs. So maybe people are, aping into really bad stocks and shares that haven't performed better than cash ISAs. But I mean, according to these latest data facts from MoneyFacts, the average cash ISA returned 3.73% between February 2023 and February 2024. Up from 1.71% the previous year. So, by contrast, the average stocks and shares ISA fund just saw a 2.8% growth during the same 12-month period after falling by 3.27% between February 2022 and 2023. The relative success of the cash ISA is due to the higher base rate, which has led banks to increase savings rate for customers. Meanwhile, stock market volatility has led to losses for some investors. However, independent IFISA returns have outpaced both, with some of the largest IFISA providers currently offering double-digit returns. And then they go on to talk about some of the returns that are being offered by some of the peer-to-peer lending companies out there, including Easy Money, which offers IFISA accounts with returns estimated of between 5.3 and 10%. If you want to get that 10%, you do have to put in quite a lot more money. The largest peer-to-peer lend in the country, Folk to Folk, has hiked up its independent, I'm just going to say ISA, because it's such a mouthful, IFISA. It's hiked up its ISA returns last year from 6.5 to 8.75%. That's a pretty big hike. Property lender Cufflink was offering target returns of 12.68% at the time of writing, while fellow property lender Crowd Property has a number of active loans offering in excess of 10%. And according to these platforms, they maintain a track record of zero losses for investors. It's an interesting article because, number one, I don't think you can talk about stock market losses unless people actually sold their stocks for a loss. Anybody that continue just to buy and hold probably wouldn't have seen those types of poor returns on their stocks. But for those people that did invest in maybe questionable things inside their stocks and share ISAs, I could see how they might have gotten a worse return than a cash ISA. That would be pretty disappointing to see. Also, it really highlights the importance of if you're buying something in a stocks and share ISA, or even maybe in a peer-to-peer lending account, that you better have a good thesis for doing it. And if you do have a good thesis for doing it, how important it is just to hold on and be patient and not make panic sells. I had an experience actually this week, last week, of my own panic selling that ended up it cost me I want to say a few £100 from a panic sell that I made. It was completely ridiculous. And it was with a stock that I had invested in just a couple of days before an earnings report came out. The earnings report came out, was very, very strong, and then the stock decided to tank. And I thought, oh, this stock is not going to come back. And I made a panic sell, and literally within 30 minutes, the stock had gone like that and then bounced right back up to even. So even myself, I do make mistakes like that, and that's why it's important, if you do have a thesis of an investment that you're making, is just to let it play out and be patient. But anyway, back to the article. So yes, it seems like the peer-to-peer lending companies are offering far better returns, obviously, than the cash ISAs, but you are going to be taking some risk. This report also said those who prepare to invest in the stock market may be pleased to see stocks and shares ISA return gross over the 12 months off the back of falls felt the year before. Savers sitting on the fence as to whether it's time to invest may feel now more confident in the stock market. The most suitable ISA for any saver will depend on their own circumstances. I think that's super important. If you need your cash to be liquid, just bear in mind there are certain investments that are going to be better for you than other investments. If you're planning on making a big purchase within the next, say, 3 or 4 months, it's good to be liquid. Cash ISAs are really good for that in some ways, because you can withdraw if you need to. But you have to remember that not everything is super liquid. So if you're investing in property, for example, it's just not very liquid. It could take a long time to get that money out. The new ISA rules coming into effect from the new tax year. So there you go. Starting on April 6th, that is the date for the new ISA rules coming into effect. That will make ISAs more desirable for savers who wish to subscribe to more than one ISA of each type per year. Regarding that ISA change, I was really scratching my head trying to figure out exactly why that rule was in place, to why you could previously only open one type of ISA in one company per year. And I think what it turned out is the government didn't think that the public were responsible enough to be able to keep records if they wanted to open 5 different ISAs that year. That they weren't responsible enough to note down how much they put into each ISA, and the government thought that you would oversubscribe to the ISAs. It just shows how much faith the government has in all of us, right? But now, thankfully, those rules have been changed. Moving on, Capital Rise expands city funding line. Capital Rise has secured a 50% increase to an existing institutional funding line and introduced a revolver mechanism to help it redeploy funds efficiently. The Prime Property Investment Platform, wow, try saying that drunk. The Prime Property Investment Platform signed the original funding line with an unnamed UK investment manager in 2022 in November. Capital Rise said the expansion to the facility underscores its continued commitment to diversifying and deepening its capital resources. The revolver mechanism will allow the firm to maximize the funding line's lending potential and facilitate smoother project executions. The move, again, some of these larger peer-to-peer lending companies, like Capital Rise is a pretty decent-sized company. They have a decent-sized loan book. They are now continuing to increase their institutional funding lines. Does that mean that they're going to one day turn their back on retail? Possibly. That could happen. We've seen it happen before. What is more likely is it just gives them more flexibility. You have to remember that institutional funding lines for peer-to-peer lending companies are quite expensive. They tend to get better rates from borrowing retail money from people like you and me than they do from an institutional line, because the institutions have to make that profit, and they have to pay for the money that's coming in too, so it tends to be a bigger spread. But Capital Rise continues to increase their lines, which does make me wonder about how long they will continue to support retail. We'll see about that. Maybe we should get Uja, is that her name? Uma Raja back on the stream again. It's been really a long time since I interviewed her in a Q&A session, but I'd really like to hear about what they're up to. I'm going to make a mental note to invite her to come on. European peer-to-peer is to grow by 7% by 2025, thanks to further developments in artificial intelligence and decentralized finance. According to a new analysis by RoboCash, technological advances will have a major influence on funding volumes in the European peer-to-peer market in the year ahead. Improvements in AI are leading to their increased use in the peer-to-peer market, which enhances the customer experience of the platforms, brings in new investors. I really don't know how AI exactly is going to be part of this, but I don't know if that's kind of robo-investing. But anyways, the merger of DeFi, that's decentralized finance, and peer-to-peer lending allows users to bypass traditional barriers, providing transparency and accessibility. At the moment, the number of such platforms is not large, but is gradually growing. RoboCash analysts calculated the contribution of AI and DeFi. So DeFi, by the way, is really strong in the crypto world. It's decentralized finance where you can lend money, borrow money through non-banking methods. And also DeFi does kind of encompass peer-to-peer in some ways because it's non-traditional, but that's more alt-fi. Anyway, RoboCash analysis calculated that the contribution of AI and DeFi development to the European peer-to-peer market is expected to reach 95.1 million euros. That's 81.31 million quid in 2024, highlighting its growing role in the fintech lending space. Overall, the combination of AI and DeFi in the peer-to-peer market can promote financial inclusion and foster innovation in the lending space. However, challenges such as regulatory concerns and technological risks need to be addressed to fully leverage the potential benefits of these technologies. In 2023, AI finance in Europe reached a value of 12.81 billion euros in 2023, which is 5.8 times more than 2017. What does this mean, financial inclusion? This is a really important term because if you've ever tried to invest into certain things, see here, peer-to-peer market can promote financial inclusion. This is one of the most important things about, I think, peer-to-peer lending that often gets overlooked as to why we even bother trying to invest through these alternative ways. There are certain things in the investing world which are off the table to us small fish. If you're a bigger fish investor out there, you're probably not watching this to begin with, but if you are a bigger fish investor and somebody who has a very, very high net worth, you have access to investments that people like me do not have. And it used to be that way with IPOs of stocks before they were released to the general market. People, small fries like me, never had access to IPOs. We didn't have that ability to invest into certain shares before they were released on the general market. Now, the internet has opened up that world a little bit, but there is still a massive amount of financial non-inclusion that happens. And what DeFi has done is allowed people to invest in companies that are developing things like blockchain technology. In the peer-to-peer lending world, oftentimes in the crypto world, oftentimes they're known as shit coins, pardon my language. But some of these companies are actually developing projects that really are going to be worthwhile in the future. And decentralized finance has allowed people like me and the small fish out there to early invest in these companies by taking, coins or cryptocurrency, which helps fund these companies. And that really does promote financial inclusion, which I think is a really important part of peer-to-peer lending. Moving on, Cufflink. They sent out a newsflash this week, which I had a little bit of trouble understanding because I'm not the sharpest tool in the shed, but this is what it said, and you probably saw this too. But it said, Lawrence, hi Cufflink. We are pleased to inform you of our latest enhancement to the Cufflink platform. From today, you'll be able to see an additional button called Reserve Pool Allowance remaining on your dashboard. To explain why this has been enabled, our investor relations team have created a frequently asked question. Here you can see right now, if I zoom in here, on the right, there is now under Auto Invest. This is nothing to do with Manual Invest, but in the Auto Invest there is a amount here which is the total pool amount. So this is how much is invested in the Auto Invest. And the remaining pool amount, so this is what is available to be invested in the Auto Invest. And the Reserve Pool Allowance remaining. So basically this is how much money, and this is what they have turned on. So you can see how much money is waiting to be put into this Auto Invest pool. So it's £1.8 million. It's quite a big chunk of change. And by the way, Cufflink is paying interest on that. So it's important to know that. In the FAQs, this is what is the Cufflink Reserve Pool. Cufflink's Reserve Pool becomes available when the pool hits an oversubscribed status. It allows investors to continue investing funds through the Auto and the ISA product. What causes the pool to become oversubscribed? Basic demand and supply. Too much money coming in, not enough projects to put the money into. Occasionally, the pool may become oversubscribed if the total loan amount or the remaining pool amount reduces due to a loan repayment. So if there's loans, get repaid, obviously that money then goes back out into the reserve pool. If the pool is oversubscribed, the outstanding funds relating to peer-to-peer lending agreements will be held in the Cufflink client account whilst waiting to be allocated to a new loan in the pool. So it goes on to show the screenshot of where we see that shown on your Auto Investing account. There was another interesting part which I thought was kind of interesting. Will I still continue to accrue interest on allocated funds? You will continue to be paid interest on the original investment amount. However, this is important. Cufflink reserves the right to return unallocated capital to you and not pay interest on these funds. So my guess is that as Cufflink starts to see this reserve pool growing and growing, and this would probably be a smart business decision for them, but they don't want to pay interest on £1.81 million of money that's just sitting in the pool if they don't have a project that they could put this money into. So there may be a time where you get a notification saying money has been sent back into your wallet. Maybe that gets thrown back at you. I get both sides of it. That would be annoying as an investor because you obviously want to know when you can get your funds invested. But from a business side of things, on Cufflink's side, they obviously don't want to be paying interest on money that's not being utilized. So an interesting announcement, an interesting addition. I think it's a good addition because it does allow you to see this amount and see how much money is ahead. If you decide you want to put money into the auto lend, it also might hurt Cufflink a little bit because maybe people are going to see that number and say, I don't really want to put my money in if I know there's so much ahead of me. However, you are getting interest on that anyways. So as long as they don't return it to you, it's not such a bad thing. Interesting too, if you go to the dashboard, you can see on this map all the different places where those auto lend projects are. There's nothing in the Netherlands or in France. Everything is in the UK. Nothing even on Ireland. Nothing even in my area of Dorset. So mainly the north, London, and some to the west. I got this email from Crowdfund. Some reason I'm subscribed to them, and also it's funny. I think it was on Monday. Somebody had emailed me asking me about Crowdfund and saying, well, what do I think about these companies that they put out for investment? So basically, you're buying technically shares, private shares in these businesses to fund them. Uh, and somebody asked me, do I think these are good investments? Well, the answer to this is it's very, very hit and miss. Some of them could be, some of them couldn't be. Now, there's a disclaimer up at the top of the Crowdfund website for a reason. This is a high-risk investment. You may lose all of your money, and it's not protected by the FSCS, just like peer-to-peer lending. The problem with these loans is, number one, look at these interest rates. I don't know if you can see that, but they're offering 24 months, 16.5% APR, and they're not guaranteed by anything that is really substantial. So direct to guaranteed, that could be worth the paper it's written on, which, again, nothing else really on this particular loan is guaranteed. So I would say this is going to be a pretty high risk procedure. I don't know how much this company is paying for their loan, but if they're paying out investors 16.5%, look how much you're going to make. Let's put in, see. Come on, is that even working? Doesn't even look like it's working. Technical difficulties. Get your slider fixed, Crowdfund. But yeah, if they're paying out investors 16.5%, the spread on that has to be at least 1.5, I would imagine more. So that could be 18%, which for 2 years is quite a lot of money for a company to pay. So you do have to pay attention to those types of things. I would say it's pretty high risk. Definitely don't put in more than you could afford to lose, because it is possible if one of these companies defaults, then this direct to guarantee is all that really protects your money. And I've always said that direct to guarantees probably not worth very much. So very careful, be careful on those. If you didn't see it, Assets Exchange sent out an investor update. They're talking about some of the things that are going on in the housing market, inflation, readings 3.4%. Also talks about some of the projects, some of the housing, some of the GDP numbers. It's kind of interesting reading. And they talk about their property pipeline. They're continuing to see strong demand for properties from their partners. They've been active in pricing up rents for new leases. It's been a slow month in terms of what they are able to add to the pipeline. They're awaiting surveying back on a asylum seeker property. But one did drop out of the pipeline because mayors have delayed taking on the property. So it seems like, with Assets Exchange can be a little bit hit and miss with the amount of properties that they're bringing, because of the nature of what they're doing is quite niche. But they continue to keep on moving forward. I got another email about the stock market this week asking me, what is my projections going forward this year? This comes off of what we saw, a pretty big $1.2 trillion funding package that was basically approved through the U.S. government. Why do you care about the U.S. government? Because the U.S. stock market seems to be a barometer for the rest of the stock markets in at least the U.K. and other first world countries. So this is a pretty big bill of spending that they've approved that's going to inject money into certain sectors and industries into the U.S., which should really, I think, push the stock market higher, even though we see this massive amount of debt that continues to increase. Look at this debt here in the U.S., $34.6 trillion, and the U.S. is only bringing in $27.3 trillion, so there's a deficit now of almost $7 trillion a year. In the UK, same sort of problem. UK debt 3.7 trillion pounds, and only bringing in 3.45 trillion in GDP. So there's definitely a big problem. The US has a much bigger problem than I think the UK, but still relative that there is an issue. So what happens when there's all this debt? The money printers continue just to keep whirring. Right here, you got another 1.2 trillion going through, and I think printing continues to happen. And then also in the US, you've got this announcement of how much borrowing is going to take place between January and March, which was Q1 of this year, $760 billion in treasury borrowings and privately held net marketable debt. Assuming an end of March cash balance of $750 billion, and then during April to June Q2, Treasury expects to borrow another $202 billion. Just again, more borrowing, more money printing, which I personally, in my opinion, think is just going to push the stock market higher, at least until October, of when maybe those numbers start to change, but we'll see when they get more announcements. Look at the Trading 212 portfolio. How are we doing? They have a new dashboard and a new UI that I really can't get my head around. It's been a little tricky. It looks a little different to what I remember. But we've been doing okay, scratching a hair under the 21,000 pound mark here, 20,904. Coinbase seems to perform well. As long as Bitcoin is doing well, Coinbase will still continue. We have 21 shares now with 4,456, up 106%. Alibaba continues to just flounder, 20% in the red. This was the play that I made when I told you about my panic sell this week, was Creative Realities. I had a much bigger holding than this and decided to panic sell some of it at a loss, but I'll show you here. You can see Monday, this is when we had the earnings. Boom. You can see how it's just really struggled, and then actually I can't remember which date was the earnings date. Let me see. Scroll. It's not letting me scroll. Here we go. But whatever the earnings day was, we saw this big drop and then a spike back up, and I panic sold, I think down here, some of it, and took a loss. I don't know why I did that. It was just a stupid move. But I did add to the position again after that, which makes no sense. But I'm a human being, and I do dumb things sometimes when investing. I do think Creative Realities, I mean, they had this amazing earnings report, and yet the stock just didn't do anything. It was very odd. Welcome to the stock market. Makes no sense. Green Power down 55%. Rivian down 27%. This was a good play. Valco Energy, of course, hindsight, wish the investment had been more, but it wasn't. That is now up 67% in 1 month. Very small energy company. Why are you not scrolling down? Hang on. There we go. I'll show you when that position was entered. It was a quick one. 1st of March, you could see all those buy orders on the 1st of March. So unusually high return. I mean, to hit a 55% return in 1 month is pretty crazy. But they did have a lot of good news that came out when these shares were bought, leading me to think that the stock price was going to do something good. But again, you never know. And then Vermilion Energy still down 37%. So that one is struggling. But we have a pretty big cash reserve now in the portfolio, 8,000 cash. Still trying to figure out what to do with it. I don't know. That's the fear of investing. When things are high, it's hard to go in. But again, if you have a thesis for investing, you should really just stick by that thesis. This is an email I got from Darren P. on 22nd of March. Dear Lawrence, I'm a fan of the stream, so I thought I would ask you a quickie. Thank you, Darren. I've been investing through a financial advisor, HL, the last 5 years. I think he means maybe Hargreaves Lansdowne, but I don't know for sure. I don't really know what that means. But he says my returns have been minimal, around 3.5% per year during what I understand was a really strong stock market performance time. The advisor has me invested in a lot of different individual stocks, including Rolls-Royce and a few big UK companies. I noticed on your videos you speak about this low type of financial advisor performance, and you advise index trackers as a way of sidestepping this type of investing. My question is, on your article you recommend the United States tracker and a global tracker. To me, it would make sense that the global tracker would be better because it has more diversity, correct? If this is the case, I think you meant to write if this is the case, wouldn't the global tracker perform better than the US tracker? I'm just looking to switch over from the financial advisors to investing myself, but I'm a little inexperienced and could use some direction. Thank you again for everything you do. Please don't feel rushed to respond to this email. So Darren, hopefully you'll watch this. I won't actually respond to your email, but it was an interesting question. It's one that I get asked quite a lot. A lot of people believe that the global tracker would make more sense than the US tracker because it's been concentrated more in the US. And what I also know is that global trackers do have quite a high makeup of the US stock market because that's the way they're made up. Sometimes you can get global trackers X. The US means excluding the US. I wouldn't advise that. I think that's a bad move personally for myself. But global trackers usually have about 60% makeup of the US stock market, so you tend to get decent returns. But what it led me to do is to pull up an investment account that I started in Fidelity in 2020 because I wanted to test out their trackers versus my trusty Vanguards, who I've become to really loathe them because of what they did, not offering the Bitcoin ETF. So I became more of a Fidelity fan because of that. But I wanted to show you what those results are, and that this has now been 4 years. So it's a pretty decent amount of time. It's not as long as if you obviously, I think it's better to trace back 10, 15, 20 years to really see these results, but I wanted to show you kind of real results. I'm not going to show you the amounts of money because I just don't think that's appropriate, but I'll show you the results here. So you can see this was made in June of 2020, and June 16th was when the cash went in. And these investments too were all put in on, I would say over a month period between June and July. So I just put bits in at a time of the amount of cash that I invested. And you can see right here the performances. So I had 3 funds: the Fidelity US Tracker Accumulation, which was the one where your money goes back into the fund and you don't get paid a dividend. The dividend does get paid on the fund, but it just gets reinvested. Then we had the Fidelity Index World Tracker Fund, this again, accumulation, and then the Vanguard Global Bond Index Fund. Originally, it was pretty heavily weighted. I think I had 30% of the bond, the Vanguard bond, and maybe like 20 and 20, would that add up? 30, 30, 30? I think it was something like 30, 40, 30, 30. So 40 Fidelity Index US, 30 World, and 30% in the bond. I ended up changing those as time went on. I put less into the bond index fund as interest rates were not being favorable to this bond fund, and the fund was actually losing money. You can see here the results today, it's down 9.6%. So if you think you can't lose money in a bond fund, there you go. And these are US and things like government treasuries in these bonds. So look how much it had gone down. It was worse than that at one point. I think it was like 14% in the red. But you can see the difference in the performance. Eventually, the US fund just really outperformed the global by almost 16.5%. So that is over 4 years. So I don't think there's any better way of showing just how much better these US index funds have done compared to the world funds. I think having a balance of both is probably good for some people so they can feel comfortable. A lot of times people don't feel just comfortable having their money invested into one particular country. However, I would say that if you think about where most of the big companies are, especially in the tech world, the Amazons, the Google, the Apples are based in the US, it might make you feel a little bit more comfortable about being just in these US index trackers. But a 16.5% difference in the return is quite significant. If you were seeing this over a long period of 10 or 15 years, you might find that that's quite a substantial amount of money that you have actually lost out on. The right play here would have been to transfer from world to US, but I left it as is because I did want to really test it out. So there's the proof, Darren. The answer is you could just see how the World Fund has underperformed the US tracker. So yes, you have more diversity. However, at what cost? Possibly some pretty heavy return costs. Now, if we look at the Fidelity US Index tracker, it's very similar to the Vanguard one. I mean, it's just tracking the indexes. You could look at the portfolio. It's basically going to be made up of just the way the stock markets are. Your 1 through 10 is your biggest stocks. You got Microsoft, Apple, Nvidia, Amazon, Facebook, Alphabet / Google, Berkshire Hathaway, Eli Lilly, and Broadcom. So you've got a big breakdown, and there's the hundreds and thousands of stocks inside this fund. So you're pretty well diversified. As far as risk and rating, you are going to be taking pretty high amounts of risk. You look 6/7 of risk because you're investing in 100% equities and stocks. But you obviously, when the stock market's doing well, you're going to benefit from that. And when the stock market is not doing well, you're going to be hurt because of that. If we look at the World Fund, the portfolio now, again, well, this is much higher. Actually, the Vanguard used to be 60% US, but this one's 70% US, and then 8% Euro, 6% Japan. So it's really a small makeup of these other countries, and even 3.67% in the UK. The risk factor of this one is going to be pretty high too. It's made up of these big stocks. Even the top 10 are just the same. But if we look at the risk rating of this world tracker, you're talking a 5 instead of a 6, and that's just because you got the extra diversification of the other countries and not just solely based in the US. But again, you are going to probably sacrifice some returns because of that. Now let's just look at this Vanguard Global Fund, what kind of things are inside of it and what the risk is. You got 99.81% bonds, top 10 holdings, US Treasury, German Treasury notes, France Treasury notes. So, risk rating is going to be a lot lower on the risk. 3/10, which is actually kind of a little bit higher than I thought it would be. I would imagine it would have been a 2, but there you go. Those are the different funds, and this is, I think, is a really good question, Darren. Do what? Number one, don't take my advice because it's not financial advice. It's just what I would do. I would go towards the U.S. fund, but do what makes you feel comfortable. If you think the U.S. is for you, if you think the global's for you, do that. And if you feel like a match of both of them, and even throwing in some bond trackers in there if you want to do that to balance it out and protect yourself as interest rates start to come down, those bond funds will perform better. You'll see the price of the bond funds go up, which now could be a good time to be getting back into bond funds, because I think maybe the interest rates get cut in June in the US, which starts to trickle down maybe into the UK too. So we could see some interest rate cuts. I don't know how much they're going to be. They could be really small. It could be just 25 basis points, 0.25%. But yeah, always do what you feel comfortable with too. And if that is the global or the US or a mix of both, I think that's good. But I think getting rid of the financial advisor, I mean, if they return 3.5% to you over the last 5 years per year, that's pretty dismal. I mean, you could have gotten a return just by putting it in an ISA or a cash savings account. You could have done better than that. So I don't know. So thanks for sending that in. Anyway, let's see if you have any interesting comments. That's all I've got for you this evening. Good afternoon from the Grand Cayman Islands. Very nice. No, the ISA is 20,000, Annabelle. It did not go up. I thought it was 20,000 still. Stephen Hale is on holiday. Hopefully you are somewhere nice, Stephen. Where are you on holiday? Hi, Aki Chat. Greetings, Paul Bagworth. Can we talk about the email this week from Assets Capital? I didn't get an email, Annabelle. So, yeah, I don't know. Maybe the, Mike says about the withdrawal fee. Is that the one you're talking about? That's crappy. I didn't like that. I've become less of a fan of Assets Capital for the shenanigans they are pulling with their fees. Ridiculous. Anyway, I think that's going to do it. I've been going for 50 minutes, so it's a bit longer than I wanted. I thought we'd be down to 30 today. Thanks for joining. Listen, have a great weekend. Thank you for joining. Be back next Thursday. I know in April, I believe last week of April, we're going to have Mike Bristow for Crowd Property on. Hopefully lining up another guest for either mid-April or early May. And yeah, that's really it. So that's all I got for you this week. Thanks for tuning in, and I'll see you next week. Take care. Bye-bye.